something. Yeah, I think now this should be better. Okay, let's try again. Okay, so what this indicator does, it's based on, I already explained in different posts, but let me explain you um, in details so you understand the foundations of this thing. Uh, Let me see, because I can show you also one of our previous indicators. Let's see if I find it. Okay, so it's called volatility, right? It's our volatility indicator. Let me open it here. So it's an old indicator called volatility that we have for a long time. Maybe I can open it together. Uh, Cover law volatility, this one. All right. If you look at this, so this is a lower panel. Let me check if you're actually. What did it do? Why did it do this? Yeah. Okay. Okay. So click. Yeah, you're seeing it, right? So let's look at the lower panel. So if you look at the lower panel, I don't know why what is going on. Sometimes TradingView is silly. All right. Yeah, I'm going to make it a little bit bigger. All right. If you look at volatility, so this is what you're seeing here is the local volatility. So the price is every single day. So you take the ratio of the price today versus the price yesterday, right? So this is what this gray line show. And we are going to change a lot, right? Sometimes we go up. So if we are actually not showing zero here, but zero, so actually one. So one, in fact, the blue line is one. The blue line is one. So above, because it's a ratio, right? So if a gray line is above one, it's a winning day. If it is below one, it's a losing day, right? So it oscillates. Um, and the red and green lines are the you can take several days, calculate. Here I'm using some kind of bell curve distribution. It's not the best distribution, but you can calculate basically the standard deviation, assuming that is a bell curve. Is not, so this graph has some limitation. Is why we made an improved version of this. But um, so it's still a useful graph because it tells you, did we go up, did we go down, and then you can average with this white line, in average over a certain period of time. You can control all these by these. So, for example, if you find it too distracting to have these gray lines, because okay, it's interesting to see they are going up but down, but it's not too useful. Um, you can turn it off. Okay, um, and then you're left with a moving average. You can choose different days. Right now we are doing 30 days. Notice if I go back in time, right, these returns are very different early on. You know, uh, you see how we are going up, right? We are not. We seem to bend, right? The blue line, by the way, is actually the power law. I say that it was one, but it's not one. In fact, we should already add it to the algorithm, but let's add a line. You can hard code it. Let's put it at one, okay, as a reference. All right, close enough. So this one, below the red line, you're making a gain. Above the red line, you're losing. Now the blue line that you see here is a theoretical curve of these returns calculated using the power law, and you kind of can see, right, if you go all the way here, that in particular because it's easier to see there, that their average kind of follow this blue line over time. So in the beginning we had much higher returns, all, even, let's say you take something in the middle. So I'll tell you what, one way of seeing that even better is to take a longer moving average. So let's say we take 120 days. Okay. See, now it's more clear that there is a pattern. And you see how that light line kind of oscillates around the blue line? That is the theoretical value that says what this value should be. Now we are calculating the daily returns, but average over 120 days, right? What happens if we do 360? That is 1 year. 360. Okay, 365, let's say. So 365, right? And you can see even better, right? In fact, really looks like, the gains were really, really high. So let me bring actually the history of Bitcoin. Yeah, you can see here where we had peaks, we have really high value of these returns. Then at the bottom, we have low values of these returns, right? Actually, fat is a very good indicator to tell us where peaks and lows are, because the lows are pretty consistent, um, similar ones, kind of. Like this one was very, very low, but the other ones are similar, where all the lows are. Mm. So it's a way to identify lows, high peaks, but kind of cycle wise, right? Not at the local level, big changes over entire cycle. But it's very clear, right? With this quantity, it changes in time. It was very, very high early on, and now it's going down, it's going down. We're oscillating around here, right? And this will continue to go down. It doesn't look like, because it looks like it's flattening, but if I zoom in, you can see it's not flattening, right? It's never going to reach one, but eventually, if we look at 10 years from now, so right now we are 1.009, something like that. That is what the power law predicts. If you compound that over a year, it's about 45%. In 10 years from now, we're going down to 22%. If we go to 20 years, it's going down to 17%. You can see that, yes, it's going down, but it's also kind of slowing, as we are approaching one. The diminishing returns are not going as fast. You can see most of the loss was early on, right? When they were, so even if you take the theoretical value, right, it went all the way to 2010. It says that we were making almost 1% regularly, right? I think average 1% a day. It is crazy, because if you combine that, you know, basically you had like you could double your money in very, very short amount of time. But you see, we are going down, right? In average, we are going down. So what do we do? And this is an indicator that is already available in your tools. It's called the power law volatility. It's one of the 15 that we have. And you can use different averaging. 1 year is very nice because it basically tells us where all the peaks are, and you can compare what is happening right now that is showing how different this cycle is relatively to the other, right? Because we should have already this line. You see how we went down here? This never happened before because usually when we are close to, let me for now turn out this right so you can see actually better. You see here it peaks here, and here this where the bottoms are. Here the bottom, here the bottom. It really finds the bottom pretty nicely, and the tops, right? Um, so right now, we are approaching November. That is where we are supposed to have the next peak, and we are nowhere here, right? We should go all much higher, and these are diminishing, right? The peak also are going down, but we should have been here, right? And also, it never happens before when we start to go up, 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 up. We have this huge big correction that bring us actually negative territory. It never happens. We usually these quantities, like here, classical, started to go up, 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 reach a maximum. Yeah, you can have corrections, but it never goes. Most of the time, it doesn't even go below the power low, but for sure it doesn't go ever in negative territory. Here, it went a little bit below the power low, at least initially, when it reached a peak. And so it never happened before. Um, Here, because we had a double peak, yes, we went below territory. But this is different because we didn't even reach a peak at all, um, unless you're thinking that this was a peak, but it happened too early to be considered a peak. Um, anyway, it looks very different from these other ones. I don't know if we are going up all the way there. We have very little time left, you know. Anyway, um, the problem with this quantity, it's interesting and it's useful, but I would like something that is more stable. It doesn't go down like this, right? So what can we do? What we can do is I'm going to turn off this indicator. Okay, so you got the gist, right? So this guy is changing over time, is diminishing. It's still interesting to see how it evolves in time, but it would be nice if we could find something that is more stable. So what can we do? Well, we can take this quantity and divide it by an equation that represents that change in time. Let me turn off this yellow line for a moment. Okay, so if I take the returns, and then it's a very simple formula. It's basically you're dividing by in particular if you do it on a daily basis. If you do some math, some algebra, and you're asking, okay, what how these returns are supposed to go down in time, uh, and they go down with t plus one because we're looking at t is, let's say, yesterday or today, and we want to look at the price 1 day after. So we add one, right? T plus one is tomorrow, right? If t is today. And so the formula say t plus one over t, and t is how old Bitcoin is. And then you take the power of n. But you don't need to take the power of n because, basically the theoretical calculation for the return says the log of the returns equal to n, some constant, times the log of t plus 1 over t. So if you divide the returns by log t plus 1 over t, you get this quantity n that is supposedly at least in average, a constant. So it should not change. If we are correct that Bitcoin is a power law, it should not change. This quantity n should not change over the entire history of Bitcoin. Now, even in a situation like this, where you can write a formula, Bitcoin fluctuates, right? It doesn't follow power law 100%. It's oscillating around the power law. So I'm expecting this n not to be perfectly a constant, but to be a constant in average. And in fact, it is, because you can take a moving average, you can do it as many days you want, like we did with the returns. Right now, we are taking 35 days. I can do it over 60, I can do it under 20, I can do it in 1 year. And, and now I calculate this quantity. Remember how the returns were decaying? This doesn't decay, it stays stable. Of course, it's oscillating, but it's oscillating instead of a curve like we observed before, is oscillating around a constant. And what is that constant? It's the power law. It's the slope of the power law, 5.9. That is the orange line here. And you see how it's white is zero. That means, you don't have a gain or loss, but this because when you divide by that formula, that we call it a deterministic, that means it's determined ahead of time. You write down an equation, right? That is really unusual, because usually stocks, gold, don't there is not an equation. I'm going to write the equation for the returns, theoretical returns of gold, right? People will think you are crazy. While with Bitcoin, you can do that. There is a formula that tells us how the returns in average should behave. And it has been right, because you will not get something that stabilizes in time if you didn't get it right. You will get something crazy, right? It will not fall. This tell us that formula is right. It's crazy that you can write a formula to tell, not just in the past, but also in the future, what the expected returns of Bitcoin are. And the fact that this quantity normalizes, right, and it simply oscillates around a constant, uh, we verify that. But you see, I'm going all the way to early history of Bitcoin, and it's simply oscillating around that constant. We don't see anymore. We took care of that diminishing returns. Right? We eliminated that diminishing returns. Now we have a stable quantity. I don't know. This should be viral. Everybody, all the Bitcoin internet should talk about these and show this graph and discussing it and trying to understand it. But because the majority of the people in the community don't understand these things, don't have any clue, and they talk about stuff that is most of the time irrelevant, very few people even understand it. Hopefully you do, or try, you're has been exposed, to this idea, because like in physics, we always look for this quantity. We call them invariant. I often mention scale invariant. This is actually another evidence of scale invariant, but this is from a different angle. We are simply doing stats. We say, okay, I think I'm assuming with this additional hypothesis that Bitcoin has this power law behavior, and we don't even derive, we don't regress anything, because regressing means you find that n. Here we don't find it. Now, by the way, that n that you find through regression, it's the same n that we get by taking the average of these values. But it's two completely different methods that give the same result. And this is more powerful because you don't do regression. Regression has a lot of possible pitfalls. You're doing something much simpler. You divide by a function. Of course, you make an assumption, but your assumption could have been wrong if you didn't get something like that. The fact that you're getting something stable, that even just by visual inspection it's easy to see, it's simply oscillating around this value, and that decay that was super visible in the first part of the presentation is gone, says, yeah, you found it. You found something that is stable for Bitcoin. Now, the other one, because we are talking now language of distribution. Distribution means Imagine I take all the value of this quantity, right? Because it's basically, I call them a local slope, because it's almost like you're fitting every single day a power law. When you calculate the slope of it power law. But we are not doing it by regression. We are doing it by calculate, very simple formula, very simple recipe. Take real returns that you measure, divide by log of t plus 1 over t. That sounds crazy, but okay, do that. It's a recipe, right? Follow this recipe, and then you get this number, and this number simply oscillates around one single value. It's, I don't know how to tell you how incredible this thing is. I don't understand why people don't get it, how incredible it is. And then you're looking how it changes, right? So you can take several days, 30 days, you're doing this in a moving average. So, you add one more day, and shift, right? And you calculate. And you're going to see it looks at first, right? If you do what is called histogram, it looks like kind of like a bell curve, but it's not. A bell curve doesn't fit very well. It's what is called a T location scale. It's not another type of distribution. There are many different. The bell curve is just one of them. Um, it's T location scale. It's much as bigger tails. That means the stream values are more likely than what is expected from a bell curve. So in other words, imagine this was height. We know that very, very, very high people are rare. Imagine if we live in a world where we were many more high people, or also short people, than what it is can consider normal, right? You can have a distribution like that, and is called the AV tail distribution. And this T location scale has AV tail. In other words, Bitcoin once in a while has this big event in both direction, negative and positive, that are many more than what you will expect if we had a normal, kind of bell curve distribution, because they should be so rare that are almost not visible. But in Bitcoin, they have a lot of these large and so positive and negative event, right, in terms of returns. So I use, in this case, I use the proper distribution, this T location scale, and then I calculate the equivalent of a mean, that is I call it mu. It's not exactly the mean, because it's not mean, it applies for the standard deviation, for the bell curve, but it kind of the same meaning. And then how fat the distribution is this parameter called sigma, basically how spread the values are. And here you can see them by the green and red line. So basically I'm adding one sigma and subtracting one sigma. If it is a Gaussian distribution, this should be 65% of the data is within this range. In the T location scale is not exactly that. I could calculate what it is, but it's a large number. Now we can add also two sigma that will catch 90% of the value will be within these two range. We can add another line showing two sigma instead of one sigma. The bottom line, though, is that you can see both mu, but also sigma early on was pretty stable, because you see how it oscillates, but you could kind of draw a line, right? You could draw a line indicating kind of like the average, right, of this quantity, kind of like there, right, the middle ground. And same thing here. Now, something happened in 17 where it made these, see here, we climb. You can show this was associated with the peak in 2017, but it happened actually several months before we reached the peak. It started to climb, reach a peak, then kind of corrected, but now it stayed high since the last 8 years. And this is all what, but there is another parameter new that tell us how heavy the distribution is, but that parameter spikes during the bubble, but have stayed constant over the entire history of Bitcoin. So the only thing that really changed in Bitcoin is this new parameter, sorry, this sigma parameter that seemed to have jumped. It jumped from here to there, but then it stays stable. It stays stable for the last 8 years. I don't know how to, again, to communicate how this is crazy, because these two things, mu, and I say new, there is a third parameter, mu, that doesn't change. So mu stayed stable because it simply oscillates around this value 5.9, and nu jumped, sorry, I say nu, but I mean sigma jumped and stayed stable too. It's oscillating, right? Again, it goes up during a bubble, etc., but it's oscillating around this value of about, I don't know, 144, something like that, 42. So this means that at least for so this in average, Bitcoin has done the same thing. But if you want to go deeper and you want to look at also how big these oscillations were around the power law, they stay the same for the last 8 years. That is also kind of a measure of volatility. So everybody says volatility of Bitcoin is going down. It doesn't. No, it actually jumped in 2017 and then stay stable for the last 8 years. Now, I think what the confusion, and we need to verify, is that if you measure the absolute volatility, it is basically standard deviation relative to the mean, that one went down. I need to verify this thing simply because the returns went down. But in absolute, in relative terms, right, if you take out the decay of the returns, so you compare oranges to oranges and apples to apples, then actually you can say it went up in 2017, relatively to early days, and then it stayed constant. But it says something, again, very deep about Bitcoin, because when you have these two quantities, you know everything about Bitcoin. You know all the statistical behavior of Bitcoin. It's basically some phenomena that is oscillating around a particular stable value, and it oscillates exactly in the same way. I, in the physics of Bitcoin show, I did a graph where it took the years from 2017 to 21, so 4 years. I calculate the distribution, and then I compare the distribution with the last 4 years, and it's exactly the same distribution. That means statistically, Bitcoin has done exactly the same thing. It's insane. And again, this should be, because it's much more powerful than the regression stuff. It's not that the regression is not valid or whatever. It's still valid. It's just this is much more convincing because it's so simple. We found a stable parameter. It's oscillating in a particular way. It has done the same thing statistically. The language of distribution, things that people in finance, etc., understand. It's exactly the same distribution over the last 8 years. That means, yeah, sure, there are times where the quantity became crazy during a bubble, but then it corrects itself, right? It corrects itself. You see how we went up as much as we went down. So it stays stable around this value. And in a certain sense, it's a special. Okay, yeah, it went a little bit crazy. It went very high, but then it corrected itself and it continued. It's not a completely different story than what we are described so many times using the regression, but now you're doing it from a completely different point of view. And in my opinion, it's much deeper because it tells us also locally what it's doing, right? It is simply oscillating, it's simply doing the same thing. It knows how somehow that it needs to oscillate around this 5.9 value. That is what it does. Okay. Whatever the mechanism is, that is exactly what it does. And it's remarkable. And again, it's a most powerful tool to show what Bitcoin does on a regular basis. I can pause 1 second. You guys have any questions? You can use voice or you can write in the chat. Do you have any questions about this? Okay. So the next thing to do is, okay, can I, this is built, okay. Um, I have to restart the recording. So what is the next step? Okay, can we actually try to make this into a useful tool? All right. So first of all, in general, you can look at the blue line and say, are we below the power law? Are we above? And you can choose different averaging, right? If you're doing over 30 days, it's a little bit slower of a process, etc. But one thing we can do, we can add to the graph, which one am I analyzing? This one, yeah. We can add to get the graph. Uh, well, actually, before we do that, let me show you one of the practical applications. So one of the practical applications, and now we can, so traditionally people look at the returns, they calculate some kind of a mean, and then they can project this forward and make um, some predictions. This basically, they say, given the latest returns, let me reconstruct some theoretical history of Bitcoin or whatever asset you want. And basically, it's called a Monte Carlo simulation. You are rolling a dice over and over again, and this dice, it's a fancy dice, doesn't have only six sides, etc. In a dice, every side has the same probability, right? Unless it's a trick dice. In these fancy dice, it has an infinite number. Well, it's a discrete thing because it's not that you can have like 25 cents, right, gain anyway. But in theory, has a lot of possible outcomes. So it's kind of imagine a giant, a 1 million faces dice or something. But also, it doesn't have equal distribution, right? It tends to go more likely towards this value 5.9 than the other ones. And farther you go away from the stream values, from the mean value, more likely is that outcome, right? So, of course, you can do a physical dice like that. You have to use a computer, but basically the same idea. So, you roll these dice with these characteristics, the same probability characteristics of what you observed. You have to do a compromise because, you know, you can find what is called the best fit distribution. It's never perfect, but we found one that seems to be very, very close to the real behavior. Then you run that quantity, and you will do a simulation of this new quantity, right? Of these normalized returns, and then if you multiply by that factor log t plus 1 over t, you get back your returns, real returns, right? 1.1 will mean 10%, 1.01, 1%, and so on. So, and the reason to do that is because one quantity is stable. We know it has no change over time. The other one is changing, right? So um, it's much better way of doing it because you're doing it over the real unchanged parameters over time. And so you don't want to fit the returns, you want to fit this one. Now, you can always locally fit the returns, etc., but it's much more dirty approach than this one. This is beautiful, it's clean, it's based on the fundamental statistical Bitcoins. And then once you do that, you can do Monte Carlo simulation. And so this is one of the tools, one of the indicators we're developing. Or it's uh, I just send it for publications. It will be available to use. The process, right? It takes a few days before it get approved. But so if you go with tools, you can. It's going to be one single indicator that does all these things. You can choose the projection here. So right now we are projecting 60 days. You can do it 5 days. If you, for example, this will be ideal to use with um, with cover calls. And I will tell you in a moment how to do it with cover calls, right? We can use with cover calls. Usually, I suggest to look at 2 weeks or 15 days. Okay, but you see how now it's projecting only for the next couple of weeks. Um, and first of all, notice what happens. So it's calculating all. You can choose the number of simulations. Maybe right now it's doing 300. If you do more, it's going to be precise. I think at a certain point there is a limit because it's computationally intensive. If we do 500, it's going to be a little bit more precise. But it's enough to do hundreds of simulations to get kind of a range of possible values. And notice first of all, you see how the red line is basically the power law. It is here in blue. It's parallel, right? It's telling us the power law. It's the median of all these possible paths. And the upper path is the craziest path that was able to find. The lower one, same thing. So we're kind of like a stream after hundreds of simulation. Yeah, one went there. Why they're so far away? Because basically it's a path. It's like an alternative universe where you roll. Imagine you're rolling a dice and you're playing a game, and highest is the better, and you're getting a bunch of six one after another. It's possible, but if you do this hundreds of times, one of the instances where you had a sixes in the row is going to be kind of almost never happens. But if you do it enough, one of these possible alternative universe will have one of you, rolling these dice six times in the row, right? So if you have a path like this that had a lot of winning days simply by chance, it's going to create a path that, you know, in that case, after 2 weeks, we are going to end up at 139. But that will be like an extreme case. This version give equal weight to both directions. We can fix it where we can see, maybe if we are like in a bullish place where, in general, you can see it's not even really the way to think about this, right? Because there are these long-term oscillations. Um, so it's something. Yeah, yeah. Go ahead. Because every time you see how the price is updating every few minutes, right? Because it's giving every time the price is updating, is trying to recalculate. But they're all basically similar, right? Actually, I kind of like. We can stop that, but I kind of like because it's retrying a new simulation, and you can see they are all consistent. They're basically kind of very similar, but it's redoing it every time the price updates. Um, and tell me again, what is what you're trying to ask? Yeah, yeah. Oh, well, first of all, this is a slight difference in the price because it starts always from the latest price. And second, it's simply, 300, it's a lot, but imagine we did it, and I don't remember what is the hard coded limit. Maybe I don't know if it is 1,000. So imagine we did it 10 million times. If you redo it 10 million, the range will be the same. You will not see any change. It's the only reason why you see some change because when you do it 300 times, it's still kind of limited. And like it doesn't explore all the possibilities. Um, like let me show if I do this like an experiment, right? Let's say I do. I don't know if there is a limit, but let's say six. Okay. Let's see what happens when it updates. Hopefully it does. Let me see if we do it 20. I don't remember what they called it. Yeah, it didn't like 6, but 20. Look at it. This. You see how much more variable it is? It goes crazy, right? Because 20 is not enough to cover all the possibility, right? If I do it 20 times, it's possible that I get really lucky and I get an extreme value. It's possible that I get unlucky and I don't get an extreme value. So 20 will not be enough. If I start to go to higher, like 100, it starts to stabilize, right? So in theory, it would be nice if we could do 10,000, but I almost for sure we can. I will test it later. I don't know how many simulation can do before it complains, because on a certain point, TradingView is limited, in terms of the things it can do. So usually you find compromises. Like, okay, you cannot do, like, if I did this offline, I can run it overnight and do a million simulation. And a million simulation, then it will be super stable. If I rerun it again with 1 million, it basically gives me the same result. Um, but you saw what happened, right? When we went to 20, it starts to go crazy because it's not enough, it's not enough runs. Um, so there is a slightly difference. It says, okay, this thing is pretty stable, right? With 500. See, it's not changing much between every run. It's like it's doing the experiment again. Say, okay, kind of, I'm finding basically the same value. If we could run it, if we could run it a million times, you can do it offline, because even with using MATLAB or Python, if you want a million simulation, I will have to run it for hours, and maybe go to sleep and wake up in the morning and leave it overrun, overnight, right? But it will run overnight, and then in the morning it will give me this result, and it will be pretty stable. But you know, TradingView cannot do a million simulation; it will crash. So we are finding a compromise. 500, I think, is good enough. Does that answer your question? Yeah, more simulation the better. So we are kind of compromising here, right? Um, yeah, but kind of now you can see after 500 it's pretty stable. So yeah, exactly. So it tell us the the median of all the possible paths is the power law. It's wiggly, but basically it's kind of almost like a straight line, right? It's very close to it. And this you can see is parallel to this one. So basically it's the power law. Uh, but then the beauty of this is that it give us a range, right? So I made it in such a way where it give us the extreme of extreme. It's probably not very useful, but okay, still useful, because it's telling us in the next couple of weeks it's almost impossible to go to 136. So that it's not impossible because it's done it, but it's like you can see from the table, basically 1%, to go in that region. Um, so it can happen, but it's like winning the lottery. Now, these orange values, are more like it's both the green and yellow combined, which is basically 50%, 50, 60%. So we could use, let's say I want to do a cover call and I want to be very, very sure. So, and you can do, now I will try to do this also with iBeat, but it's the same thing. You will have to do a little bit of math with iBeat, but maybe we can add a table that tell us the value for a bit, add it to this, because iBit and Bitcoin are linked to each other. They basically are doing this kind of the same thing almost. The only difference that you can trade iBit only in weekdays, while you can trade the Bitcoin every single day. But so if I wanted to do um, a cover call, let's use the price of Bitcoin. Right? You can do directly. So if you are a European, or some other country where you have access to buy Bit, then you can trade directly options using Bitcoin. Here in America, it's much more complicated. I think there are some places, but it's better to do IBIT. And IBIT, you can do it on Robinhood. I do it all the time. And you can do it a simple percentage thing, right? So, for example, let's do an example. So, let's say, in fact, my contract is expiring in 2 days, and I will open another one. In fact, when I open another one, we can do a meeting then. This will be the 19th. Let's see what is the 19th. We can do it together, maybe in the morning, if any, Friday. So Friday we could do another call, and I can show everybody how to do it live. And I will record it so people can also use the recording and learn how to do it themselves. Because it's really, I think at this point is the game that everybody should do, even if you have the Minotaur system, because it's an additional thing that you can do and to get yield. So you own Bitcoin. In this case, you will have to buy IBIT. That is kind of like buying Bitcoin. You don't have the self custody, but eventually you can sell the IBIT and buy Bitcoin with it. But you can accumulate IBIT over time by doing these cover calls. And what does it mean for the people that have zero experience? Basically, let's say, like I can show you also in my Robinhood, but and it's as easy as buying a stock or Bitcoin, anything. You just need to learn how to do it. And let's say on Friday we will do step by step. But so you look at the chain, right? So you look at the expiration of the next sequence of contracts. So without changing screen, I can look it up because I have it open uh, in my computer. So I'm going to look. So you're looking. There are these tables, right? So basically, and again, on Friday I will show everybody to do. And it's very easy on Robinhood. I can even do it on my desktop. Um, I'm old-fashioned with that. So I do it on 19 because I have already a contract that will expire on 19. And by the way, I'm making quite good money on that one. So the next one is September 26, right? So because it's every 2 weeks from the last expiration, that is 19. So I'm looking at all the different contracts, and the idea is, what is a cover call? Basically, you're giving the right to somebody that wants to buy this right to buy your Bitcoin at a given price. In this case, is IBIT, but like I say, it's completely equivalent. Okay, and they can show you how to convert from one to the other. But imagine you did it with Bitcoin, because you can do it directly with Bitcoin on Bybit, for example. I'm going to give, I know it sounds crazy, but let's say imagine you could do this directly with Bitcoin, that you can on Bybit, Binance, same thing. Um, it's just that Americans don't have access to this. So stupid. Uh, I'm going to choose a point here in the middle because, of course, it will be safer to choose this red area, but it's such a far away price that probably nobody wants to buy the right in 2 weeks. Imagine say, hey, do you want my Bitcoin for 139,000? I give you the right. I'm going to give you this contract, and I give you the right to do that. Of course, maybe you don't want to give away all your Bitcoin, but let's say you give away one Bitcoin, right? And you're not going to give, yeah, this person is paying you $139,000 for it. But they have to pay in addition a fee for that, right? Because if it was free, of course, sure, if the price goes to 150, I'm going to buy your Bitcoin at 139. Because you see, it doesn't matter what the price is. The price says you are going to buy at this price. Of course, nobody wants to buy them if a price in 2 weeks go to 125, because why will we want to buy at 139, right? They will not do that. It will be a loss for them. So in that case, you say the contract is expired. So if in 2 weeks the price doesn't go above the price, expires, and what happens? Well, that person needs to pay a fee to get this right. You're not going to give away this um, privilege of buying your Bitcoin for a given price unless this person pays a fee. Now, farther away the price is from the current price, and less these people are going to buy. So we don't want an extreme price because probably we don't find a lot of people that want to buy. Maybe there is some crazy person that does it, but they are not going to give you a lot of money for that. So you want to compromise. The game here is to find something where you feel pretty confident that is the risk of selling your Bitcoin, because after all, you don't want to sell them, right? You want to keep them, is pretty low. Now, if it happens, you rebuy them immediately, and anyway, you made some money. So unless you don't act or the price corrects and explodes or something, um, it's a pretty low risk activity. Now, everything, right? You would not be able to make money if it was some little risk. There is always some little risk, right? Risk is, imagine it jumps and it goes crazy and you don't have the time to actually rebuy back your Bitcoin, right? You could even put an order to be safe, right? An automated order say, hey, if there is a change in small percentage, buy immediately, something like that. There are measures that you can take to minimize the risk. And also it's a game of probability, right? If you do this 20 times and 18 times you win, well, okay, you lost a couple of times and you lost a little bit. Because you have to understand the price needs to go higher than what you are predicting, or the price limit will be, because you have to include the fee that this person. Like for example, right now, just to give you a practical example, I have a contract that is expiring in 3 days on the 19th, and this person bought the right from me to buy IBIT at 65. And you say, Giovanni, you're stupid because you give away your IBIT at 65. Well, really, if you include what he had to pay me to get that right, the price will have to go above 69. And it's not going in 69. I beat right now, it's what, 66 or something. It's not going in 3 days to 69. I'm pretty sure I'm going to cash in. By the way, you cash in the beginning when you sell it. And of course, um, if you have to sell it, you will incur, if the price went much higher, and let's say including your fees, it's a loss because now you're selling something that you didn't want to sell for a lower price instead of the current price. But again, it's a game of probability, right? So again, let's do it more a practical example. So let's say I want to play this game, and they say, okay, I'm going to sell. So 136, 38 is too high. If I maybe 127 is too low. I think actually this brown region in particular in 2 weeks from now, it's pretty safe. So one could use that one. But in fact, let's use it. Let's use it. And then if you want be a little bit safe, you could go a little bit higher, maybe a couple of percent higher or something. So let's say I go with the brown region. The brown region is 127. Right now, we are 116. So this allows also to do the conversion to IBIT, right? Let's do a percentage. What is the percentage? So if I take 127 and I divide it by 116, I get 10%. So basically, close to 94%, right? It's a change of 94%. So let's double check what the IBIT price is. It's 66 37. So let's add a 9.4. So 66.37. I'm going to add 9% to that. Okay. You can follow along if you like. That will be 72. Okay. So I feel very confident to sell my right, to sell the right to buy my IBIT. You need, the game implies you have some IBIT. Uh, And by the way, these are these are option contracts, so we have 100 shares. You need to every contract is 100 shares, so you need to have at least 100 IBIT, that is about $6,000, right? If you have 1,000, so $60,000 worth of IBIT, it's even better. And again, it gives you the exposure to Bitcoin because it basically does whatever Bitcoin does, IBIT does, and plus you can do this game. Now, if you can do it directly with Bitcoin, it's great. But okay, so in 2 weeks, and in theory, we should do this when the contract is over, that is on the 19, and then we can do the next one. But it's okay, we can do it now. So I can look at the chain, and I'm going, what did we say? We say, what was it? 72.3. Okay. So I'm looking at the chain. I'm going to look at the contract. So right now, so let's round it down to 72. So right now, if I'm looking at the chain, I can take a snapshot and put it in the chat so guys can check it. Right now, there are people that are willing to buy my contract, basically this right to sell, to buy Bitcoin at 73. Let's say I bid. To me, they're interchangeable. I know that people don't think in that way, but for our purpose, we are. Um, so they will buy each contract at 15 cents. I know it, so to know how much you're doing, you need to take these 15 cents and multiply by 100, right? It is only $15. I know that doesn't sound a lot. Now, of course, if you this is only with one contract, let's say you sell 10, that means that you have 1,000, then it will be 150, right? So it becomes a little bit more of a valid game if you have at least $100,000 worth of IB, right? So then we are talking about hundreds of dollars instead of $10. But I'm just showing it as a kind of example, right? Now, you could take a little bit of a risk and say, 72 is up there. What if I go a little bit lower, right? So if, for example, 70, it will be more like 45, right? So in this case, 0.45. In this case, you will make $45, right? And $450 if you had if you sold 10 of these contracts. That means about 66,000 worth of IBIT. So you can do the math. But this means every couple of weeks, even if you had only 10, right? I know it sounds stupid, but you will make $15, right? By doing something. And there are people that want to buy. There are few, but there are some people because. So let's see. For example, let's go back in Robinhood. They even tell you how many people basically want to see the volume, right? So they were about 1,500. In fact, the 70 for some reason, yeah, the 73 had even more volume. There are about 1,000 people wanting to buy. This is today. Wanting to buy that contract. So you will find buyers, and if a price doesn't go there, in 2 weeks you cash in $15. I know it doesn't sound, but $15 on a $6,000 investment every 2 weeks. It doesn't sound too much, but it's still something. I mean, I know people that have done this with relatively large amount of money, and we do it consistently. Maybe taking a little bit of a risk. Maybe you want to go to the orange, to the brown area instead of. I was trying to be, very very conservative, like always. Uh, I mean, I will not take too much of a risk because the entire idea here is that you want to keep your IBIT because basically you will be buying, keeping um, your Bitcoin, the equivalent of Bitcoin, but without recording into. Okay. Yeah, so this is one of the things that you can use it, and I think get $6,000 worth of iBit. You will learn. It's on Robinhood. It's not very. It's not something that is relatively affordable for most people if you have some savings, right? Um, and then you can play this game, and it will become clear how to play it. It's very very simple, and you can do it every 2 weeks. That is, unfortunately, we don't have, as far as I know, we don't have. I think it's every 2 weeks. Also because I mean, you could do it every week if you want it. It's just that 2 weeks is gives you a little bit. Um, yeah, there are expiration every week if you wanted to. But I will choose every 2 weeks because it gives time for the price to stabilize a little bit more. So I think it's idea. But we could also test every week. I know that sounds crazy, but I know that people that using iBit did close to 5% every month. That is crazy because if you could do this with that discipline of, and it's not like where you have to stay glued to the screen every day. It's something that you do every 2 weeks, or even if you want to do it every week, once a day. Look at this chart, come up with a price, place the trade, done. And you just do it every 2 weeks or every week. And you get this consistent flow, right, out of just holding these assets. Now, some people say, what about tax, etc.? Do it on your IRA. You can do this with your IRA, um, self-directed IRA, and Robinhood. You can do it as self-directed IRA. So take a portion of your investment in Bitcoin, get iBit, and I mention iBit because for the US people it's the easiest thing. For the people that are in Europe, just do it on Bybit and do it directly with Bitcoin. I think there is less volume, but it should be good enough. Between Binance and iBit should be enough contracts where you can do this. So I do it every couple of weeks. I open these positions and I cash in. And then what do? You buy more iBit. After a certain point, you will have enough where this thing is self-sustained, right? If you increase where you got 100 contracts, now you can sell two of these um, option contracts, right? And you can continue to do it over and over again. It's a feedback loop, um, and it's particular safe. In particular, if this is the future of Bitcoin, where we simply oscillate around the power law. This tells you the range, likely range. Can it be wrong? Yes, because it's a probabilistic thing, but it will be right probably 90% of the time. And it's pretty safe game that you can play over and over again. It doesn't require too much time. Um, yes, the gains are small. If you take a little bit of a risk, and maybe can you choose like a middle? I will not. Probably, if you the biggest risk, I would choose something that is maybe 10% below. Um, the red area, so right now that is 128. So, maybe one 116, 117, right? Something like that. You can use also the table, right? So maybe if you go in the yellow area, 127, it's pretty safe. But 137 probably is the orange area. Yeah. So you could use yeah, that range, or maybe 10% below the range or something. That is starting to take a little bit of a risk because higher the risk, of course, people pay you more. Uh, But so do you understand how this works, guys? It's pretty straightforward, right? How to use a simulation. Uh, okay. So the other thing that this thing does, uh, let me go back to this graph, is if you go back here and you add a yellow line, you can turn it off. In fact, maybe I should make it a parameter, but um, like a parameter that you choose here. But you can do it also graphically like that, turning on and off the yellow line. If you turn on the yellow line, what is a yellow line? The yellow line, we are recalculating this mu, but now we are calculating over a short term. And in fact, that you can also decide the default parameter should be optimize it. So I'm choosing 35 days for the long term and 3 for the short term. But you can play around with these and see what you get, as an experiment, etc. But go back to default if you get lost. And so basically, we are calculating this distribution, right? And we're calculating where this mu is over a much short term of time. So basically, it's going to change much more than the blue line because it's over a short period of time. So it's a response more to whatever Bitcoin is doing at the moment instead of being kind of a longer term trend. And see what happens. We get very nice signal because every time these I call it short-term mu and long-term mu. Every time a short-term mu goes above the green line here, right, that represents the upper limit, right, the farthest away return when we add up. And remember, it's we're doing a moving average, so it's not just over the last few days; it's over the last 30 days. So we had pretty nice 30 days where we had a very extreme value. These are extreme value over the period, and the short-term changes are going above that, right? Like here. Well, it's probably a time when so here the correction was, which was kind of a bad December. The correction was that the price kind of stabilizes and then you had another leg. But in general, these points are points where there is some kind of correction, like this one or this one. Okay, so it's some kind of there is some kind of correction downwards because basically say, okay, I had too much of an extreme, I'm going to correct, right? And same thing here when you look at these green dots because they are the intersection with the other side when we had losses, a bunch of losses. Now I made these, so it's already here and it's showing all these potential values, right? Kind of visually tells you, are we close to a minimum? Are we close to a maximum? But then I change these into this will be a separate indicator. Basically, it's the same thing, but now I made it into a strategy. Let me turn off these, and then we can look at that. Now it's a strategy where I'm choosing, and let's see the parameter I choose here. So it's doing, okay, it's doing the average over 30. I think this is optimized actually to find this local minima and maxima, and then 3. You can experiment, but the beauty in making it a strategy is that instead of giving you all the potentials of all the candidates, it actually chooses value. Now we cannot optimize that. Maybe choose basically is looking for the first time it goes green and then chooses that as your entry point. We maybe there is a better way of doing that. Optimize. Maybe we wait for one and choose the second one. Let's see. Let's see what we can do. But they're pretty good. Look, it wants to buy here and then sell here. This was a gain. He wants to buy here and sell that. Maybe this was a wash, right? It kind of are the same height. He wanted to buy here and sell there. Now, the beauty of doing it with TradingView is that it gives you the stats, and it says that this thing was 77% right. So 77% of the time you had actually a gain, and when you had a gain, 3.67, uh, 3.67, your win were 3.67 larger than your losses. These are the two main parameters to kind of judge how good the trading strategy is. Are you close to 100%? No, because you're not going to have a 100%, right? It's 77. That is pretty high. Anything? Imagine going to a casino with a you know with stats of this kind, right? With winning rates of this kind, they will kick you out of. They think you're cheating, right? They're kicking you out of the casino. Not even the casino itself. The casino, they allow the casino to have a little bit more of a winning rate, but usually it's like 52, 53. It's actually legal. The government intervenes if they are set up your slot machines, or the roulette or whatever, where they win more than a certain percentage, and usually that is just a few percent. Imagine having this thing, right? And then actually, when you win, your win are much bigger than the losses. This is a very, very good trading strategy. We can improve it, but how will you play this? Well, in this case, you can do Bitcoin. Again, you will have to access some of the derivatives like futures, for example. Coinbase is starting to have futures. They are beta testing it right now, so this is also something that US people can do. You will buy here with a certain confidence, because it looks like if we are correcting up. You will get some leverage, like maybe five leverage. I will not do any of these degen things where people do 100 per leverage. Just do something that gives you an edge, but it's reasonable. Make sure you have enough collateral where you don't get liquidated and so on. Open a small position, 5 pair, sell here. You will get pretty good gains, and then you can buy Bitcoin with that because you didn't have to sell your Bitcoin. Use your Bitcoin as a collateral. So right now, for example, we will have bought here. We are waiting for the signal to sell, and again, you will have made some good money doing that. Buying here, sell there. So this is how you can use this one. Now, eventually, right now it's a strategy, and it's our first strategy. And again, you get it for free. You have a signal. You can. I think TradingView allows you to send emails because you don't have to act immediately. It's not that you have to rush, etc. You will have to do it that day, because these are daily signal. Now we can check how it looks if we do hours or things like that. We will have more trades if this works also with hours. But it will be still every few days, right? It will not be every single day. Um, you can send a signal through email. Whenever you go on the computer, you can do that action that tells you to do buy or selling. So it's not something that you need to automate. But in theory, if it is, you can use things like Tricoma. We'll do that. I will have instructions on how to use it on Tricoma. So there is third parties that basically take the signal from TradingView and execute automatically on an exchange. I don't know if they are going to have Coinbase. Hopefully, they have Coinbase. But right now, again, for the people that can use Bybit, this could work on Bybit. And I will have instruction how to do it if you never use Tricoma. So basically, you link it to your TradingView and say, hey, when you get this signal from this indicator, act on it, do whatever you need to do. And it will be automated, and this is basically an alternative to the Minotaur for the people that cannot afford. Now, Minotaur is better than this, many, many times better because, instead of doing one trade every few months, it does many more trades, it DCA down. This doesn't do anything like that. It kind of finds what he thinks is a local minima. So this candidate will have been better. Uh, if we did this with Minotaur, we'll have bought a little bit there. It will have bought even more here. It's kind of DCAing down. That it's very, very powerful. And this doesn't, it's a simplified, right? But, this is why you pay $20 and you will pay thousands of dollars, right? So because I just want to give you tools, right? Whatever tool helps, because I think this will be my message, different from everybody else. That is, we need to get some yield with this Bitcoin, because 45% is nice, but if you want to go back, I calculated if you get even 1.5% yield a month, it's almost like going back 10 years ago. What did they calculate? 5 years ago. It's like going back 5 years ago. Um, and 5 years ago, the returns were much higher than now. And and what happens over time, you're going to multiply your Bitcoin. So I calculated that in 8 years from now, 9 years, Bitcoin will be a million. So we have 10 pair from there. And this thing, if you get 1.5% a month through any of these tools that I'm describing, including Minotaur, you get 5 times more Bitcoin in 8 years. And now we are talking about, 50, 60 times, 60 pair relatively to where you are. That if you start with something decent now, it's going to be life changing. So Bitcoin is still a great investment, but unless you buy tons of it, you're not going to retire in a little while. But with this approach, where you get with this new mentality, old plus, we can call it odl plus, right? With odl plus, maybe it's a slogan. With odl plus, you can multiply your Bitcoin while hodling, because you're still hodling, but now you're putting to use your Bitcoin. And I don't see, now, of course, it doesn't come at zero. Even hodling has risk. This is a little bit more risky, but it's a control risk. We are trying to minimize our risk, and this is why we are trying to get 1.5 and not 10% a month. 1.5 is, through all these tools, is very achievable, and it doesn't require you spend all day long in front of a computer. Now, everything else, like people find all the kind of excuses. Oh, but what about taxes? What about this? What about that? You know, um, do it on an IRA account. Do it, you know, there are ways of, and anyway, it's taxes on something that you will not have otherwise. But it's better to pay, some percentage taxes on something that now you have, or zero taxes on zero. Zero on zero is zero. 10, 15% on something is still something, you know? So I don't see why people raise that stupid objection. It's not a good objection. Anyway, I think this kind of, oh, wait, the last thing, so we are also developing these indicators with Chris, that is this partner of mine, one of my different partners, that he has many years of experience in Wall Street. Sorry, I'm drinking some water. And he's very interested in this log periodic power law that I mentioned many times. We work with Sornet, and we created these indicators that are, again, works around, because if you had to do the full calculations using TradingView, you will die. TradingView will die because it's too uh, intense computationally. But you can find workarounds, work with what you have. It's not perfect, but it's come very close to what the full log periodic power law will tell you. The entire idea is to find states where something happened. So basically, you change your way of thinking about the market, and you say, listen, we have two states. nothing happen, something happens. That sounds very familiar to any Bitcoin, right? Bitcoin seems there are this period of time where nothing happens, and then all of a sudden something happens, and you have like this fast correction in one direction or the other. Well, these things tells you when that something happens. Basically, on the same day it happens. That is basically now the full log periodic power law is supposed to be even predictive, where ahead of time. But like I say, it's too much for TradingView to do it. Uh, and TradingView, why we want to use TradingView, because everybody can access it. Even you don't need to code. Somebody can write this code for you, and you can use it. Right? It's a much more accessible tool. Now, eventually, this is a project of mine. I want to do like a place on the website, for our members, where you can go and get the full calculation of the log periodic power law. But we are not there yet. We can work on that. And that will be predictive. It will tell us ahead of time. But even there, it's predictive probabilistically. It tells you there is a high chance that something is going to happen, right? Until it really happens, you don't know. But most of the indicator that I am familiar with, they are delayed. They tell you that something happened after it happened. Like 99% of indicators are like that. They happen, and it's not the same day. It's 2 3 days later. This one on the same day tells you something happens. Now, it gives you a confirmation that something happened maybe a couple of days later, but you don't need for that confirmation. What do I mean? Well, look at this, right? The something happened state is a white tick line. Whenever that line happens, something is going to happen to the market, some kind of a correction. Um, and, and there is some convergence between my indicator and this one. Like, for example, look at this. Here, we were going down. Now, what is happening? Usually the opposite of what happened before. So if we were going down, we are going up, right? So something happened there that said, hey, it's going to be some kind of a correction, and the correction is up because we are going down. So you could have both here, but is exactly where my algo says to buy. Now, notice there was another one here, and again, my algo say, but the strategy say here because it chooses the first one. The price went down, but it was like just probably catching up with the last liquidity available. It was more or less the same. Of course, this price was better than this, but kind of the same thing, right? This chunk, you can consider it one big chunk where the price didn't know what to do, but we knew what it was going to do. It was going to go up because this white line started here, and in fact, my indicator say buy. Like I say, this was even a better buy, but if it's difficult to respond at the moment. Now, notice the confirmation came when you start to see the second line diverging. So when the second line diverges, it confirms. And in fact, let's say you couldn't act on this because it didn't diverge, but you acted on this, you will have got the price here. Kind of the same, right? But this probably was not completely actionable, this point here, because it will be magical if you could do that, right? But pretty close, right? You will have both in this area, and then when the change happen next here, and you could have sold there. If you wanted to wait for the confirmation, now actually the confirmation happened here, or maybe here, right? So kind of sell in this region. So you bought it here, you sold there. Okay. So this is this. So now you have one more indicator that is really powerful based on a completely different approach that actually converges with this one. And when you have, that is the best word, when you have more than one indicator telling you the same thing over and over again. I would say Chris indicator by itself is very powerful, but when you combine it with these, it's just amazing. It's not going to be ever 100% correct, but it's 100 times better than any TA tool that I ever saw. It's really, really powerful. And so you will do the same thing. You will do these future contracts with a little bit of a leverage. I will suggest about 5, maybe 10 at most. And then, you will wait a few months and then you can cash in. Depends how much you invested. It could be, if you invested, let's say 5,000 with a 10 leverage, that will be like investing 50,000. And now, basically it's like whatever gain you got over 50,000, this, how much of this was. So, you went from one, let's say you sold it here at 117 and you bought at 80, whatever it is. Let's see, what is 60%? 117. Sorry, I cannot do this on my head. Over 80, let's say 46%. 46% gain, but if it is 10, you invest 5,000 with a leverage of 50 will be, you know, that gain over 50,000, 46% over the 50,000, plus, okay, some fees, but they are not very expensive, these futures contracts, in terms of fees, very manageable. So, and whatever gain you add, now you can buy more Bitcoin and do this again and get again and again. Okay. So these are tools, and I think really this is what the smart Bitcoiner needs to do moving on, to be a little bit more active, being a little bit more involved, learning how to use these tools. We have a community for that reason. We can share ideas, we can do it together. On Friday, um, probably around, the market opens too early for me, uh, and I am not a morning person. So we'll do it. It doesn't matter when you do it. We'll do it during the day, maybe at 10. I will do like a show 10 PST, and I will show you all the steps I do to buy the next to do this cover call for the next couple of weeks using these tools. Okay, I think this covers most of what I wanted to cover. Do you guys have any comment or questions? You can write, if you don't want to talk, you can write it in the chat. And DVP 196. Yes. So if you do the Monte Carlo and you extend it to the end of the year, you can do that. Let's go back to the Monte Carlo. TradingView does something silly where, and by the way, here I even show you the slopes. We can add also the single slope. It's kind of visually cool to see. So if I extend it at the end of the year, which I already did in this one, this goes, in fact, all the way to end of the middle of December. It says that it will be kind of half of a percentage probability to go to 200K. So it's just a couple of percentage going above 100, 190. So yeah, 200K is very unlikely that it happens. But this is what it is. The beauty of this is the power law. Um, Power law is um, more than stronger than ever, more valid than ever. Is because if we don't go in these bubbles where usually the power law was challenged, so every time we had a bubble, that was a challenge to the bubble, to the power law. And the only reason why we went back to the power law is because the price then eventually went back to the power law. But it took about 2 years for this process, right? We left the power law for 1 year, We went back to another year. It took 2 years to go back to, and then we have 2 years of pure power law behavior. Now, if we have 4 years of power law behavior,